start the show, and so you will be home by dinner. So, do you have any kids or a wife or?
Yeah, so I'm married with two boys. One is in second year university in Montreal, and I have another one in grade 11, and I have my third child, which is my mini schnauzer. And he
Beautiful.
can't. He's the one who's most excited when I get home for dinner because he knows when I get home, Daddy has a drink, and then we play ball. So he can't wait.
Super, Barry.
Denne podcasten og innholdet skal ikke anses som investeringsråd. Hensikten med podcasten er å bidra med informasjon om finansmarkedene og selskaper. Podcastvertene er selvlærte hobbyinvestorer og ikke finansielle rådgivere. Informasjonen som gis i podcasten utgjør kun våre personlige meninger. Hvis du legger vekt på noe du har hørt her, gjør du det på egen risiko. Verdipapirer som diskuteres i podcasten skal ikke forstås som en anbefaling til å kjøpe, holde eller selge nevnte verdipapir. Podcastvertene kan være direkte eller indirekte eksponert mot verdipapirer som diskuteres.
Kenneth, would you like to do the honor and introduce our next guest for this week's episode?
Yeah, I think you should have the honor, to be honest.
Okay, then listen, guys, we have a huge guest. It's an absolute honor to welcome Barry Schwartz from Canada. He's the fund manager of Baskin Wealth Management, and he is a huge fan of high quality stocks. And since our listeners also have gotten to know the Canadian markets with the likes of ATD, Dollarama, CNQ, and Constellation, we have the honor of having Barry Schwartz with us today. And welcome, Barry Schwartz. It's a huge honor. I'm really starstruck.
Come on. Oh, thank you for having me. You're giving me some imposter syndrome right now, but I appreciate that I can share my views for you guys and talk stocks. What I like to do all day long. Think about the market, dream about the market. We all have this passion in us when it comes to investing, and it's something I think just comes from trying to learn and get better investors. And what I want to do is just make my clients, comfortable in their retirement. And that's what gets me to tap dance to work every day is, keeping my eye on the prize, which is I have a huge responsibility of managing a lot of money with my team for clients. And we just want to, do the best we can. And hopefully they follow along and understand our approach and agree with our approach. And I think, as you guys would probably say, owning high quality companies is the right approach if you're going to do, if you're going to invest long term. It's the only way I know how to do it. Happy to share our story, how we got to this approach, because I wish I would have had that epiphany a long time ago. But excited to answer all your questions and just have a chat.
Yeah, we really look forward to have you on board for approximately 1 hour. I know you have to get home for dinner.
Well, yeah, it's if I don't get home for dinner, then then I'm going to be left on my own to my own devices, and I'm not a very good cook. So, yeah,
Yeah.
but we got lots of time, so let's get into it.
Yeah, Barry, you mentioned that you look for high quality companies, and you if correct me if I'm wrong, you're from Canada, right?
I'm from Toronto, Ontario, Canada, one of the world's largest cities, growing quickly. And born here, raised here, went to high school, university, met my wife here, and now manage money for clients across Canada, some in the U.S., but born and bred, that's where I'm staying. I think one of the greatest countries in the world. No offense to yours.
None taken. Could you tell us a little about your development as an investor, as how you came to come across your investment philosophy and your strategy?
Absolutely. So I just turned 50 years old, which I can't believe. And my sons call me a boomer. So to add the insults there, that's fun. But I've been investing and working as a professional at Baskin Wealth Management now. This is my 24th year at the company. Prior to that, I worked at a mutual fund company in Canada doing back office data entry work, which I did not like, but it was my first job, and then went back to school to get an MBA and pivoted careers, got a CFA, all that kind of stuff. But my education as an investor started young in the sense that my father, he's now retired, but at the time he was a CPA, a chartered accountant, and always talking about the stock market, always interested in investing. And he would dabble in Canada. 30, 40 years ago, it was mining stocks, right? It was mining and oil. Everybody was investing in gold and those kind of things. You had a few conglomerates, but really a different market, of course, than what it is today. And that was his way of fooling around with the market. And so I was always interested when he would talk about the stocks that he purchased. But the fun part for me, or where I started to learn about investing, was when I had my first job in 1997. I was living on my own at the time and accumulating a little bit of money through my job. We had a matching program, and everybody was investing in tech stocks. This was the dot-com boom. And I was able to get my reconciliation done every day at about 11 o'clock. I kind of I kind of fooled around at work and pretended that it would take me all day, but really I had to reconcile a couple of financial statements for the company every day and had to get it done by 4 o'clock. But I was able to get it done by 11 a.m. And so I had the rest of the day to do whatever I wanted, pretending that I was actually working, but I was trading stocks. And you know what? Everybody else at the company was trading stocks because everybody was trading Dotcom-stocks. And so I was lucky enough over from 1997 to 1999 to turn about $5,000 of bonus money and savings into $100,000. And that to me was crazy. I had purchased, you remember AOL Online? That was a huge winner in the dot-com boom. There was all these dot-com names in Canada. There was one called bid.com that was like a precursor or similar type company to eBay at the time. All these companies turned out to be worthless. But instead of working, I was trading stocks, and it wasn't because I was a genius. It was because I got lucky and rode that crazy market wave. No one investing today who wasn't around in the dot-com boom truly understands the mania. Stocks were going up hundreds of percents a day. We had some euphoria after COVID, and people will talk about that things got overheated and it was silly, but nothing compared to the dot-com era. That was just insanity. You had mutual funds that went up 60-70% a year for 2 to 3 years in a row. Of course, everybody lost all their money when it was all said and done. So, guys, I got lucky in the sense that I turned in 100,000, and then I decided to go back to school because I hated my job, and I was also getting married at the time, so I cashed out, used that money for a down payment on the house. Had I stayed in the market a few months later, because I purchased my house in the summer of 2000, had I stayed in the market a little longer, I would have lost all that $100,000. So at the time, I told my wife, I'm not going to go back to school. I'm not going to go get a job. I'm going to be a day trader. I'm so brilliant at trading stocks. She called me an idiot, and she was right. It wasn't it wasn't because I was so smart, and I just got lucky by cashing out of stocks well before the market imploded in the summer or October of 2000, whenever that happened. And luckily, David Baskin hired me, and that's where I've been the last 24 years.
That's a brilliant story. Do you think we are in a mania state right now regarding AI, perhaps, or do you think it's still got some room left to run?
Well, we're not seeing mania in the sense of companies going public with no product, no services, just a dream, and having valuations in the multi-billions in 2 minutes. We're just not seeing that yet. That was the mania of the dot-com boom. That was the insanity. So what we have right now is you have Supermicro and Nvidia and some of these big tech names that are super profitable and beautiful balance sheets, and I don't know, I don't see any evidence of a mania there. Of course, you do hear everybody ask you, why don't you own Nvidia? Maybe I should have put a few bucks into Nvidia. Of course, everybody missed it. It's the same people that wanted to buy Tesla at the top. So it's hard to say that there's a mania in it, but I guess we'll only find out in hindsight.
Yeah, I think so too. Good points there. But what led you to going from trading to owning a really quality companies? Because I've seen your portfolio, and how do you compose your portfolio now? And what do you look for in a company long term? Since you're not trading anymore, Barry.
Yes. We're not trading. So, well, keep in mind what I was doing for my personal account 24 years ago, knowing nothing is completely different than what we're doing today. So, I guess to go back, I was hired at Baskin Wealth many years ago as an analyst, jack of all trades, doing admin work, whatever it was to get our business growing, and assisted my partner David Baskin as he was a portfolio manager and chief investment officer at the time. And over the last 24 years, I've become an equity partner here and moved on to become a portfolio manager and now the chief investment officer, and working my way to build the portfolio for clients the way I'm comfortable investing. And so I'm the majority owner, or not the majority owner, but a large owner here at the firm and the chief investment officer. And so what I've learned over the years is what works for me as an investor and applying that to for our clients, if that answers your question. But how do we compose our portfolio? How do we think about our portfolio? Well, it's pretty simple. We're looking for companies that are able to compound our clients' capital. One of the metrics that you look at, of course, is return on invested capital. One of the metrics you look at is free cash flow per share growth. You look at for returns on equity. Look for companies that have the ability to lay out capital and are excellent at earning a terrific return on that capital. If you put, if you and I opened a bank account together and we are earning 30% a year in that bank account, would it matter if you paid 30 times earnings or 40 times earnings or 25 times earnings for that return if you were compounding it that quickly? No. So our thought process is, yeah, we don't want to overpay crazy for a company, but we also don't want to fiddle around on valuation, especially if you can own a company that is laying out capital and reinvesting it at high rates of return. And that's how you get wealthy in the stock market. You own a collection of those type of companies run by brilliant managers who know how to allocate capital well, and let them do their thing. Stay out of the way. And what I mean by stay out of the way, stop trying to trade that stock.
Yeah, that sounds great. So a lot of the stuff that you mentioned are like crunching numbers and stuff like that, and that's open information for everybody to see. So what do you do on the qualitative basis? How do you find the winners that can really compound?
I wish I could tell you what if there's where the secret sauce is. I think you have to be open to a lot of different learnings to compose a portfolio. All right, so what do we do for clients? We manage a portfolio of 30 to 35 high quality companies. We try to diversify across different sectors and industries and countries and management styles. Those are the things we're looking for. But all those companies have a lot of things in common, right? They have what we think is management that knows how to allocate capital. At the end of the day, if you're going to hold a stock for 5 years, 10 years, 15 years, 20 years, or longer, management is probably the highest thing that matters, right? And so you can own a company that has low margins like Costco, or a company that has high margins like Adobe. But if your management doesn't know how to allocate the capital properly, it doesn't matter. It matters less what valuation you paid for it. So that's kind of our thought process, is management matters. And so for a qualitative investor, you want to drill down on the management skills, the allocation skills. How do you do that? That's not so easy. But what you're looking for, and what we're looking for, is one thing that helps is finding management that have skin in the game. All right. I love it that we own companies like Canadian Natural Resources, or TFI International, or Couche-Tard, where you have these owner operators that are holding billions and billions of value in the stock and not selling. That tells me that they still have a high degree of confidence and certainty in the business. You look for you try and obviously invert the acquisitions that they've made, and that goes back to more quantitative, but seeing their success in capital allocation. And if you put together a bunch of those companies, I think that's when you start to get some pattern recognition about what works, and put that together, of course, with certain business models that you think will be successful in the future.
Look, Barry, we are a podcast from Norway, and we are retail investors. And last year, I got some suggestions to look at the Canadian market, which was quite foreign for me. And I was lucky; it was the Silicon Valley bank run, and the market was kind of spooked. So I looked at high growth, low yield compounders like ATD and CNQ, which had high yield then. But do you think that people are just looking at your neighboring country, the US, and not looking at the beautiful Canadian companies, which you can be a nice ambassador for Norwegian retail investors? Because Constellation and ATD has crushed the markets over decades.
Well, you put a lot of points out there. So first of all, as an investor, you should be open to investing in the best businesses wherever you can find them, right? And so it shouldn't matter if the investment is in Norway or France or Canada or the United States. As a professional investor allocating money for clients, and with a mandate of owning 30 to 35 of the best companies, we have to scour the globe and turn over a lot of rocks. In Canada, there are a few wonderful businesses. The Canadian market, just to go back and break it down, the Canadian market is dominated by a lot of mature businesses. The Canadian banks are a huge part of our index. We have Canadian telcos, we have Canadian railroads, utilities, pipelines, oil and gas companies, gold mining companies. So very much a index that is asset heavy, commodity heavy. And a lot of the Canadian names that are independent or compounder like, there's not too many of them. No question in the United States, it's a better environment to find businesses. I think we can all agree that if you only had one place to put your money to invest long term, it would be the United States. The venture capital market there, the private equity market, the university innovation, the subsidies, it just is a fertile ground to build the best businesses in the world. In Canada, I think we have a more of a serial acquirer style. There's a number of Canadian companies that are excellent at making acquisitions. I don't think we have the university base, the venture capital base, the capital base that created such amazing technology companies or innovative healthcare companies, but we have, for whatever reason, we have our fair share of really excellent allocators. I think a lot of people can, obviously name Shopify as an innovative company in Canada, and that's kind of it. Is Constellation an innovative company? No. Did they do anything interesting, exciting or new? No. But Constellation Software founder Mark Leonard knows how to allocate capital. Elaine Bedard at TFI International, I don't know if you mentioned that one in Canada, knows how to allocate capital. The guys from Couche-Tard, Alimentation Couche-Tard, know how to allocate capital and are great at making acquisitions. So there's about 10 or 12 really good capital allocators in Canada, and some of them on purpose hide themselves from other markets. Right? The stock is only listed in Canadian exchange, and the guys running them are not promoters of the stock. They don't meet with. They don't do a lot of presentations, and they do those things on purpose.
And good points. And Brookfield Management as well is a nice favorite Discord. And
Really?
you love that company as well.
Yeah, we've owned Brookfield probably for over 20 years for our clients, and the Brookfield that we bought 20 plus years ago is not the Brookfield of today. It's really been, it's been created. It's an ongoing creation by Bruce Flatt and the other, senior partners at Brookfield, and he's a guy that he's a guy you want to invest alongside. He has an unbelievable vision, and the ability to invest a lot of capital in very huge markets, and he's a little more promoty than maybe some other Canadian CEOs, but for good reason. He has a great story to tell. And so, yeah, I think there's, we can get into a number of Canadian names if you want to review them, but lots of interesting Canadian companies that I think deserve a little bit more attention on the world stage. And some of them are getting attention. Obviously, Constellation Software is now pretty well owned by a lot of foreign investors. Brookfield as well. Couche maybe not so much. Then there's also companies like First Service, TFI International, Descartes Group. There's just a bunch of these serial acquisition businesses that have absolutely creamed it, and as well as some other commodity type names like the Canadian Railroads or CNQ that we can talk about as well.
So among those, do you have a personal favorite?
I don't like picking favorites in stocks because we own 30 to 35 names, so it's hard to single out what is your best idea across the board. Our approach is, when we're building a portfolio, we like to buy we like to start out with equal weight positions, and probably different than a retail investor who, there's no rules to being a retail investor. You can buy and do what you want. But when you're managing money, for clients, you have to be a little bit more rules based. You have to be cognizant of overweights, of positions that get too big in your portfolio. Those are, you have fiduciary responsibilities that unfortunately sometimes outweigh the financial aspects of owning some companies, right? I can't put 30% of my portfolio into Constellation Software. Maybe I should, but I can't do that for our clients. And so picking favorites is hard. I would say that every stock that we own is our favorite. It may not be our favorite at the specific time based on valuation, but they're in the portfolio because we really like them. And generally, guys, if we're owning a stock in our portfolio, we're going to be buying more of it. We take the approach that if we own it, we're buying more, or we're getting rid of it. There's no if, ands, or buts.
Sounds good. Good answer. Need to have conviction on the entire portfolio.
Yes,
so
our approach, yeah. Mm-hmm.
Yeah. So we were curious about because you also noticed that there are several serial acquirers, and you touched on the best of them. I think the Constellation Softwares of the world and ATD and yeah. So how do they win?
How do they win? Well, they win by really knowing how to make money as a serial acquirer. So what is a serial acquirer company? It's a company that generally lays out capital at a lower valuation than what its stock is trading for. It uses debt or equity at smart times, and sometimes that acquisition can be done at advantageous prices. Sometimes there's economies of scale with that acquisition, or network effects, or some other benefits that happen by making an acquisition. But at its basic core, what you want to do is your stock is trading, let's say, at 10 times earnings, and you want to buy companies at 5 times earnings. And each company that you bring into your model at 5 times earnings obviously gives your company a valuation bump. That's a serial acquisition model. That's the private equity model that works. Do you have the ability, though, to be an operator, right? So what we talked about there is just being a financial person, right? Making money by financial engineering. But can you acquire something at 5 times earnings and have some secret sauce to improve margins? Have some secret sauce to get some economies of scale, some network effects, make that acquisition at 5 times earnings, and turns out, because you know what to do, it's now an acquisition that was done at 2.5 times earnings because you've cut costs. And those are the things that you don't hear about, but that's exactly what Constellation Software or Alimentation Couche-Tard or TFI International or First Service is able to do. They're able to make these great acquisitions, A, because they have the capital, B, because they companies that are selling to these great acquirers know that their employees will be treated right. Maybe they'll even offer them some shares, or be able to keep part of the ownership. And of course, they just have a way of improving the operations, whether it's cutting costs through right sizing the business by laying off some people that were redundant, improving the Couche-Tard buys one gas station. Well, now that fits into a network of 3,000 gas stations that are in a location, right? So buying the chocolate bars and the beer all of a sudden becomes cheaper. And they can slot in top management who know how to make the retail stores run better. So all these little things that you don't hear about and you'll think about when you own a stock go into the hard and heavy lifting once an acquisition is made. And it's just rinse and repeat. And so that's what you're looking for in a serial acquirer. You are competing against private equity and who's able to borrow money, but they're not really operators. They're more financial operators. And what a Constellation or Couche-Tard will say is, don't sell to private equity. They're going to blow up your business and screw it up, and your legacy's gone. Sell to us. we're going to fix your business, improve your business, maybe even want to buy shares in our stock and benefit from what we're doing.
Exactly.
Yeah, that's a compelling story.
Yeah.
I think
But
that's the best description I've heard of serial acquirers. So it's
Cool.
just great.
but Barry, to more the technical part of serial acquirers, because you can't use PE ratios and profit margins and so on. What is the key parameters you use? Do you use NOPAT, EBITDA, or price to free cash flow? What are you defining good value in serial acquirers?
It's a great question. It's kind of like this one is, when you see it. um, you can tell by how quickly the acquirer pays down debt, how the revenues have and margins have improved over time. You have to follow, obviously follow the words, but look at the financials and look at the trends of the financials, and are they improving as a result of these acquisitions? So is 1 + 1 = 2.5? And that's what you need to see. Is the return on invested capital not going down as they're making these acquisitions? Are they breaking it out to show you that margins are improving at the business? So sometimes you rely on management to show you. I mean, what's improved there. Look at Constellation Software. They made this gigantic acquisition in the U.S. and they've already turned it around. This is Altera that they made. They carved out an investment from a competitor that was showing gigantic revenue decline, and they've turned it around. So you need to trust management, but you also need to verify, and it's very helpful. A lot of these companies will break it out and show you how margins have improved over time, the return on invested capital of that acquisition, the free cash flow. Um, you, I know it when I see it when a serial acquirer isn't working. That's pretty simple. When the debt of that serial acquirer starts to significantly increase, the free cash flow is not improving, and the margins aren't going in the right direction. That's when you need to run away from a serial acquirer. So serial acquirers can be great investments, but not everybody can do it well. I mean, we're all cherry picking when we talk about the Couche-Tards and the TFIs who've done it well, but for every one of those companies that's done it well, there's 99 that have blown up, so that I'm not sure that really is a great answer to what you asked, but that's the best way I can answer it.
No, I get what you mean, because it takes a lot of experience. It's like we are quite interested retail investors. We really look for qualities, and when you have read 400 Q reports or annual reports, you know what to look for.
You know what to look for.
Yeah, it's like you said. When it comes to serial acquirers, I haven't found the secret sauce that you have had, but I trust, as you mentioned earlier in this episode, the management, like in Couche-Tard or in Brookfield or in Broadcom, just to mention another one in the US. But one question when we are talking about Constellation, do you see more spin-offs happening in the near future, because they have over 1,000 business units, if I'm not mistaken?
They have over 1,000 business units, and they also have what they call verticals, right? So they have all the companies that they acquire in the legal space is a vertical. All their companies that they acquire in the hospitality space are a vertical, and transportation. So they have a number of these verticals. I don't know how many they have, but it's probably well over 10, right? So they've spun off Lumen, which is in the media telecom vertical. They've spun off Topicus, which is focused on acquisitions in Europe, but broad. So Do we see more spinoffs? I mean, that's been communicated well by the CFO Jamal Backish, that Constellation plans on spinning off multiple verticals going forward. We've seen what they've done with the spin-off of Topicus is really making a large acquisition, and instead of paying cash for that acquisition, merging the company with one of its verticals and then spinning that off into the market. And so that's a new way for Constellation Software to not dilute current shareholders, but offer those that they're acquiring, large ones, shares in a new entity. So let's say the three of us wanted to sell our business to Constellation Software. They're only paying cash right now, right? And so maybe you want the cash, but maybe you want to stick around and not sell your company but get equity. Well, how are you going to do that if they don't want to give you shares of Constellation Software? You can't. But by spinning off, let's say the vertical of, I don't know, transportation, making a large acquisition of a transportation software company, spinning it off and merging it with their vertical and spinning it off. That way, I can sell my shares of my company to this new company tax-free, defer my capital gain, and participate in the upside of this new vertical. So that's a way that they figured out to make 1 + 1 = 3. So they've done that with Topicus, they've done that with Lumen, and the acquisitions that they've made, the guys that sold or merged are running the companies, right? The CEO of Lumen was running his own vertical. So that's the strategy that Constellation is using for its spinoffs, and you can imagine that they'll be spinning off all these verticals at some point in time.
It's genius.
It's not genius; it's financial engineering, but it works, and so I think it's very important to Mark Leonard and the other senior people there that they not dilute shareholders. But like we said, not everybody wants cash. I own 40% of Baskin Wealth Management. If someone were to offer me a great offer today for that 40% of my shares, I still may not sell because I'm going to have to pay a huge capital gain. But if I was able to merge 40% of those Baskin shares into a new company that I thought would make me more money, and we could grow it even more, maybe I would consider doing that. And so that's the thought process for those verticals. So you've seen in the last few years that Constellation has figured out that they can now carve out units from large companies. And this is the next evolution of serial acquirers. You start out small. You buy these little rinky-dink companies for 1 million, 2 million, 5 million, 10 million, and the snowball gets bigger. And now you're so big that buying these 1 million, $2 million revenue companies doesn't move the needle. So you start looking at larger acquisitions. Well, that gets harder, and you're talking about people that have huge capital gains in their business, whatever it is. And so you have to come up with creative ways to offer to make those acquisitions. And so what we'll see is they'll merge with larger entities or carve outs or what have you, and spin them off at the same time. And the other thing it solves for Constellation is it more aligns the people that work at that vertical with what the performance of that vertical is achieving, right? So let's say I work at the Constellation Software transportation vertical and we're having a great year, but the other verticals aren't doing so well, right? Maybe it's a tough year for the accounting vertical or the legal vertical. Well, my efforts at the transportation vertical are not going to be as well rewarded. So what you want to do is reward people in those specific business units for the performance that they've achieved. And it's not so easy when you have 10, 15 different verticals that, are flying high or doing lousy at the same time. So that's what I think they're trying to achieve. But obviously, you'd have to ask the management for their opinion, and they're not going to tell you. So we can only guess.
Yeah, that's fascinating. So one thing we oftentimes see with the serial acquirers is that that you don't have the best information about the the companies that they hold, and you kind of have to guess how they're doing, and it can sometimes lead to discounts from what you believe that the underlying assets are worth, but the holding company is trading at the discount relative to the underlying value. And for instance, this has happened.
Do you have any examples of that?
Yeah, Brookfield Corporation.
Okay. Yeah.
Or at least, what Bruce Flatt thinks is the intrinsic value of the underlying holdings. But so I don't know if you have any comments regarding that.
Well, Brookfield is a complicated company to analyze, and not as easy as maybe a Constellation Software or a Couche-Tard, right? It has a number of different divisions and assets and overlap and how the assets are held. A number of publicly traded spin-offs, which it continues to own stakes in, and it's not an easy company to figure out. I get it, and I every time Bruce Flatt tries to make things easier, he sometimes makes things harder. So that the market is not, investors don't want to do the math, and figuring out some of the parts is a very tough process for investors. And I'll be the first to admit that a sum of the parts investment is too hard for me as well, because it's not how business doesn't work that way, right? You can't just break up all the units and cash them all out, and that's what it's worth. So it was more meaningful to me is looking for the trends. Is the NAV growing? Are the top line growing? The free cash flow per share growing? Is management buying more of the stock? What are they doing with the free cash flow that it's generating? Those are more important than trying to figure out what the sum of the parts is worth today. What's the discount? And it's always traded at this discount, but now it's even wider. And I should sell it now because the discount is smaller. That's really hard to analyze and figure out. When I buy Brookfield, when we own Brookfield, we're owning it because we think it's a growth company and has its fingers in a lot of large markets. What's the largest market in the world? It's financial markets. And so Brookfield is participating in that by managing money for institutions, large institutional investors, and getting a management fee. We all can understand that, as well as a performance fee on the funds that it manages. And financial markets are a huge place and very innovative, right? You can offer an equity fund, a private equity fund, infrastructure fund, credit fund, derivative fund, insurance fund. And so Brookfield is slowly increasing its into the financial asset pie by getting into different areas of the financial markets, right? It just launched this insurance business. It's a spread business, but still, insurance is a huge business. And they're involved in real estate. Real estate is a gigantic market, which is not always going to do well at every point in time. So I think it's more important to focus on less on what the current value is and more what are they doing to create value in the future.
Yeah, I agree. And with Brookfield specifically, I really like the story where they have come from like being an operator of the businesses that they now own, and so they can, as you say earlier, operate these businesses better than most, and there's a lot of hidden value in that when they acquire something new. not only just the economies of scale, but they can turn around stuff and get more value from stuff.
That's it. I think we just nailed what it takes to be a great serial acquirer is having those operation skills. Not just using the financial engineering, as we talked about, buying something for 5 times earnings and having the market value at 10 times earnings and rinse repeat. It's really adding value by being a great operator, and I think Brookfield has proven to be excellent operators. And yeah, everybody on who doesn't like it, they can tell me the bear case, and it's pretty clear. But the company has clearly been an excellent allocator of capital. I think they have a beautiful runway ahead of them. So we've owned Brookfield for clients for 20 plus years. I prefer owning BN, the parent company, versus BAM, which is the asset manager, because the parent BN owns 75% of BAM anyways, and it's going to participate in the growth of a lot of financial markets going forward. It's investors are moving away from traditional stocks and bonds, even though I don't necessarily agree with it for my own investments and for my clients. This is the way the world is going, and Brookfield's going to have exposure to a lot of those fast growing areas, and excited to continue to be a long time shareholder. As long as Bruce Flatt's not selling his shares, I'm sticking around.
Yeah, me too. So it's really interesting, but we gotta go move on in the program, and I really wanted to touch on to frame this because we talked about verticals, and we talked about new business units, and these operators, owners, that they can see new opportunities and then pivot, use the capital, use the skills to create new businesses. And I wanted to do that in the context of these really big tech companies, but because we could notice that we noticed that you own Apple, Amazon, Microsoft, great businesses that just they don't just do one thing and one thing good, but they do a lot of stuff, and they have they increasingly do more stuff. So how do you think about finding or companies that does more stuff over time? Not a great way to frame the question, but
I think I get what you're. Okay, so we've owned Microsoft and Apple for well over 10 years, and great businesses have a way of surprising you. And when we bought Microsoft, and I think we started buying it in 2012. All right, it was just a company that sold PowerPoint and Word and Microsoft Excel and the operating system. And every couple of years, they'd come out with another operating system, and they'd get you to upgrade, and you buy, the physical floppy disks or CD disks, and buy everyone a license in your office for a new one, and rinse repeat. And the thesis was, as we get more digital and more offices get access to the internet. Sounds so ridiculous, right? But this is, what happened over the years as, Microsoft there'd be more computers being sold, and Microsoft could get more real estate. How could I have known in 2012 that Microsoft was going to be in the cloud and be in video gaming to the extent it is today, and be into enterprise? And you can't know these things, but what you can know is some of these platform businesses, these businesses that have captive customers, they figure out amazing things. Once you've got a customer where you're able to sell them a product and they keep coming back year after year, you figure out ways to sell them other products and services. And as long as you delight the customer and you don't piss them off, and you don't raise the prices too much and turn them away, wonderful things happen. And it just turns out that these companies, because they generate so much free cash flow, that they're really good allocators of capital. And so I came to realize, or we came to realize that platform businesses that have, double-sided markets can create enormous value. And the internet, the growth of the internet allowed for companies, which were locally based to sell things to anybody around the world. And so that's the value of these Magnificent Seven, or a whole bunch of them, is the platform a business combined with selling recurring revenue products and captive customers, and it just exploded. And so, do I need to know every single minutia about Amazon and Microsoft and what they're working on? I mean, no, it's impossible. It's impossible to figure it out, and you don't know what they're going to come up with in the future. We can see that they're spending what, hundreds of billions of dollars combined on capex and significant on R&D, and hopefully they've hired the brightest and the best people and continue to reward shareholders with excellent moves in the future. But that's the insight of owning those big tech names. And as a generalist, I can't pick out specific software companies. I'm at a disadvantage. So those are the names that really work for the generalist investors. Is the large cap big techs.
Yeah, exactly. And I mean, regarding they have beautiful network effects, and they seem to, the more they scale, the more cash they produce. Like the revenue that like Amazon and Google and Microsoft have are just astounding.
Yes, and some of them are just so they're moving on to the next stage, a few of them, right? So Apple is now quite mature. Although I am super excited about the Apple Vision Pro, as well as the next generation of AI tools that they can offer, the retail customer through upgrading their iPhones, and I hopefully we get some interesting announcements this summer. I can see the Apple Vision Pro or some type of future iteration being a remarkable enterprise product. We've done calls with those that are experts on Apple and what they're doing, and I mean, you could just see how the Vision Pro will change enterprise for the better. Whether it's meeting with your doctor with an Apple Vision Pro, here's a perfect example. You have a business and everybody now works from home 2 or 3 days a week, right? It's tough to get people back in the office. You hire people, you want to train them. You got one guy working from home on Tuesday, the other guy working from home on Thursday. How do you train people? Well, if we're both on the Apple Vision Pro, super easy to start training your employees that way. You don't have to sit side by side to teach them this is how we do things. You show them how we do things by both being online. So I can see companies using that product for meetings, for training, for you name it. The enterprise, I think, is going to be massive. But getting back to my point, I'm probably getting off tangent here. Is these companies are morphing now into cash. They've got too much cash. They don't know what to do with them. And so you saw, of course, Facebook launch a dividend. Booking.com the other day launched a dividend. You'll probably see Google start a dividend at some point. Amazon start a dividend, and these companies will just become massive share buybackers because they're going to have nothing else they can do with the money. Facebook was the first one that's gone crazy on the share buyback, and so we didn't even talk about share buybacks, but creating value through buying back 3 to 5% of your shares each year, even if your revenue growth slows, also creates enormous value for shareholders, for those that are patient.
Yeah, Apple has done that, right, with their share buybacks.
Absolutely, right? So one could argue maybe Apple's revenue growth is going to be tough going forward, and there are risks with China for sure. But if they can reignite the top line just a little bit, combined with continued massive share buybacks, you can still see a pathway to pretty decent returns going forward. And you never know what the future is going to bring and what markets they're going to get into. But that's the thought process with some of those big techs. Is the world's never seen business models like this before. We can't comprehend how big these companies have gotten, how large Microsoft's now almost a $3 trillion company. That's insane. It's mind-boggling. It doesn't make any sense, but it does make sense because they're playing in such big markets and generating so much free cash flow and reinvesting that cash flow into other big markets. At some point, and it's probably pretty close. These companies won't be allowed to make acquisitions. So they're going to have to come up with innovative ways to get growth. And we're probably there for some of those companies, but the next evolution will be just, okay, we'll just buy back all our stock that we can over the next 10 years and we'll see what happens.
We have two more questions for you because we are at the end of this program. One is, I'm a huge fan of consumer staples like Coca-Cola, Pepsi Company, and Hershey, and so on. Would you? I've had a discussion previously with some friend of mine who also invests in the US and in Canada. Would you like to describe Apple as a staple? And don't get me wrong, it's a tech company, but given that their iPhone is their how should I say it? Their gold mine in revenue, and since the bottom line is perhaps going to grow with 6 to 8% annually the next 5 years, if the forecast from the Wall Street is correct, would you describe it as a staple kind of with the recurrent revenue, or would you say it's more like still just a tech company?
I mean, my crazy thought process is Apple is it's part of our life. Those that use it, right? Imagine not looking at your phone, 3 times a day, or however, just like you have to eat 3 times a day, right? And so I'm thinking people look at their phones 1,000 times a day. It's like something we're completely all addicted to. It's the highest consumer staple. It's a consumer it's a non-discretionary product. You can't live without it. People literally start shaking when they can't find their phones, or they've lost their AirPods, or people can't contain themselves if it's been 10 minutes and they haven't looked to check their Facebook or their email or texted their friend. We all see it. Like, let's not beat around the bush. This is the most addictive product the world has ever seen. So, and it's trading at 25 times earnings, and we're all worried about because Huawei has come up with a better phone in China. That's just not so nonsensical. So it's something we can't live without right now. I'm actually shocked that it only trades at 25 times earnings. This is the most they own the world, right? And so how does Nvidia and Google and all these and Meta, all these companies exist without Apple? It's hard to see it, right? So, and Apple's still gaining market share, which is something no one talks about, right? It's this market share continues to climb worldwide. Maybe not so much in China now, but so yeah, it is a consumer staple in our opinion. Is something going to disrupt the iPhone? Are we going to be looking and checking something else in the future? I don't know. It's a pretty good product right now. It's been going strong now since 2007 so pretty good. That's my 2 cents on Apple. is people need to think about it differently. It's better than a recurring revenue business. It's better than a SaaS business. It's the best business in the world. It is the absolute best business in the world. And you're either it's like US politics. You're either a Republican or a Democrat, and you're either an Android person or an Apple person. I mean, what else is there? And the Apple people make fun of the Android people, and the Android people think the Apple people have are clueless. And that's what Apple has created is the most phenomenal business in the world. And I still think they have the ability to sell more products and services to more people worldwide, and probably at higher prices and better margins going forward.
I totally agree, Barry. It's when you just talked, it was like listening to Mozart, because I've been a retail investor for like 10 years, and I haven't owned Apple yet, and I'm actually uh, trying to find some weakness in the market to try to buy Apple at a reasonable discount. Anyways, I would like to say that the Apple fanatics, it's kind of a lifestyle, as you mentioned, really.
Yeah. Yeah.
So, to the last question, it's kind of a two-part question. What is what would you like our listeners to have as a take-home message from this podcast? With your experience as a fund manager, with a lot of money under management and the responsibility for your clients, what would your recommendation to the retail investor in Norway to kind of to take home, or to to reflect on?
Well, I've never been to Norway. I would like to visit one day, and I heard it's beautiful. But as for an investor, the world's a big place. And so, we all start as investors with learning about our local countries and the investments there, because we're there. We see it. We see the companies and we use the companies, and we know people that work at these companies, and so that's how we all start off as investors. Um, so how I started off as an investor is, yeah, of course I'm only going to invest in Canada. I live in Canada. It's easier to do research on Canadian companies. I can speak to the management of Canadian companies. I can't have a conference call with the Apple senior management. They're not going to talk to us. So you get different access and better access, but you need to it's just like religion. There's no right answer. There's no right path. The path is the one that works for you, and you have to learn in investing is trial and error. Yeah, you can read a million investing books, and that could help. Listen to a billion podcasts, but really, you just got to get in there and start investing and find your own style. And if you're good at trading, then be a trader. If you're good at buying crappy companies and selling them for a little bit higher than what you sold them at, and rinse repeat, then that's what works for you. There's no right answer. We're all just trying to hone our craft. To me, you said Mozart. I feel like I'm just painting a picture and trying to get that picture better every time and refining it. And it's what my career is all about, is just trying to get the best portfolio. And yeah, sure, I'd want to be one of the best investors in the world. I don't know if that's a ridiculous goal, but that's what everybody should have, is just get better at your craft. And investing is a craft. And so find your style and your approach and do what works for you. What works for me as an investor is buying and owning great businesses. That suits my temperament. It suits the way I want to invest. It's what gets me excited. I feel that as a long-term investor, there's no other way that I could invest but buying great businesses. On a down day for my company, I'm excited because A, I either get to buy more, or B, I know that company probably thinking about buying back its stock. And an up day, I feel great because I made money on the stock. So I feel like as a long-term investor, I can't lose. And our approach is very patient. I've owned a lot of these names for a long period of time, and I just want to keep going with them. And I hope that we can continue to compound our clients' capital by being those sidecar investors with a great management team. They're not easy to find them, but there are a lot of them. And once you own a great long-term investment, just my advice is to stick with it. You mentioned a few minutes ago about I'm waiting for a good entry point. That to me is the most dangerous thing you can do as a long-term investor. Like, what do you like? Would you think you can time the market, or the precise time to buy a company? If you buy Apple, I mean, I'm not saying Apple, this is the right time or wrong time to buy Apple, but if you've done your work on Apple and you feel that you can compound your capital over 5 years at by better than the market return, then buy the goddamn stock. So our job as active investors is to beat the S&P 500. There's no better index in the world than the S&P 500. There's no better diversified index of the best companies in the world. The S&P 500 does around 9. Okay, so your job as an investor is to beat that 9%. Or what else are you doing? So you should be looking for companies that compound capital at faster rates, that you can buy at least a reasonable valuation, where you can do the math and you can come up with the ability to double your money in 5 years. That's what I'm looking to do. That's what I think any long-term investor should be doing. They shouldn't care what the dividend yield is, or that it's trading at 26 times earnings and they really want to buy it at 23 times earnings. Maybe if it's trading at 40 times earnings and you think it's worth 25 times earnings, you don't buy it. But that's what you should be thinking about, is can you compound your capital faster than the S&P 500 over the next 5 years? If you can't do it, buy the S&P 500 and go read a book. But if you think you can do it, then give it a try. And I think that's what we're all trying to do as long-term investors, is we think we're stupid and brave enough to think we can beat the S&P 500, so we're just going to keep on trying.
The great Barry Schwartz. I loved your answer, Barry. Really, really. This was an amazing episode. It was lovely to have you on board with us, Barry.
Wow, thank you very much for having me. It's always a pleasure, and happy to come back anytime and talk. Yeah, we didn't even get into really specifics about some other Canadian companies, so whenever you guys want, I'm here.
You can sure bet that we will invite you again, because I know you have a busy schedule, and you have to make home for dinner, and the time zones are quite different. So it's difficult. So you have to come and visit us, Barry, plenty of more times, because you are really an inspiration, and I recommend all of our listeners to follow you on X. We will put a link on Spotify to your profile and to Baskin Wealth Management for more information about you and your fund. And
what about my podcast? Can you plug my podcast?
Yeah, sure. We will.
Of course.
We will. Of course. Of course. There's a lot of nice content there. As I mentioned before we started the recording, I loved your last episode about CNQ and how you actually get the entire business for a discount, really, because just their oil oil reserves are worth 100 Canadian dollars. So it was a really nice nice episode. Perhaps a confirmation bias because I love CNQ, but I liked the episode.
Thank you so much.
So, do you have any requests or wishes of what the episode should be called?
I don't. I don't. It's up to you guys. Just appreciate how many listeners do you get?
A couple of
podcast.
thousands.
Pretty good, man.
Yeah, in Norway we only have 5 million inhabitants, so we are quite satisfied with that number.
Getting about 3,000 to 4,000 listens per my podcast, and so you guys are doing a great job.
Yeah, thank you, Barry. Thank you.
Job, yeah.
Okay, so I think maybe if we could call the episode long-term investing with Barry Schwartz. I think that captures most of the stuff we talked about.
Pretty much.
Super. Then, Barry, we will definitely have you on board later on, perhaps already later this year, if you have the time.
No worries. That hour went by quick. Thanks for having me,
Yeah,
guys. Have a great night.
yeah.
What time is it for you guys? Is it midnight?
It's 10 o'clock in the evening.
Oh, all right, not too bad. All right.
Yeah.
Have a good night.
Have a good one. Yeah. Thank you, Barry.
Thank
Take
you very
care,
much,
guys.
Barry.
Thank you so much. Appreciate you guys, and take care. Bye-bye.
Bye.